The markets just took a hit, and it's not just because of one thing. In fact, we could blame all types of the headlines we got out today, including the weaker than expected jobs report we seen, surging volatility, fresh tariff headlines that has everybody on edge, not to mention lumber prices spiked to a 3-year high. Restaurants are pleading for relief, and the bond market is sending a very clear message to the Federal Reserve. Let's break it all down. Sit tight. We got a lot to cover today. So based on the intro, I bet you can guess the direction the entire market took. The stocks, crypto, everything, the trend was down. And we'll get into the news that was driving markets today, but I want to work our way there, so just stick with me. Today we've seen the put to call ratio, which is a type of alert indicator that people watch, which trended to its highest level since mid-June, but it's still way below its April tariff-driven spike that we've seen. But some people are starting to hedge this market, and that is what this is showing. And then back to Webull real quick, you can see this bottom right chart right here. That is the Wall Street's fear gauge, and this is the VIX, the volatility index. And what we've seen today is that this jumped 19% to around 20, going as high as almost 22, and then it hovered back down to around 20.38, which is where it sits right now. Still a pretty modest level, but this is also viewed as an alert, just something to sharpen your eyes on, because it's a sign that people are getting a bit uncomfortable with where we are right now in the economy. But everything's been going pretty well leading up to now. Earnings have been pretty great. Tariffs have been viewed as a win with all of the announcements coming out. Everything's been pretty good. And back on earnings, out of the S&P 500, so 500 companies, 317 of those companies have reported earnings so far. And so far, out of the 317 companies that have reported, 83% of those companies have beat profit forecasts. But heading into the two tougher months of the year, August and September, which is pretty questionable about performance gauges in those 2 months, we're seeing less optimism and potential upside for these companies that beat being a lot less. And we're seeing this because when these companies beat earnings, they're either moving up slightly, not really a lot, or not at all, or even down. And then if these companies miss and they report bad earnings, the downside, there's a lot of downside that we're seeing. So the risk and reward's pretty much off. And it's probably because a lot of the optimism was baked into the cake prior, and now like markets are just getting what they were expecting and it's not better. So there's still room for a tariff shock if businesses start doing bad and start reporting worse earnings or guidance due to the not favorable tariffs that are coming in. But something that can save us is AI, assuming Trump doesn't announce levies on these chip companies, because chip stocks have been the winners and have been what's lifting the tide for all ships here in the stock market. CapEx spend for AI contributed to more growth in the U.S. economy in the past 2 quarters than that of all consumer spending, and this is pretty huge. AI spend is more than consumer spending for growth-wise towards the economy. Just like think about that. So the head of the economic research of Renaissance Macro Research reported that and let us know. So Google, Microsoft, Meta, and Amazon are set to spend almost $400 billion on capital expenditures, largely to build out their AI infrastructure. That amount is more than the entire European Union spent on defense last year. And the plan for their AI spend is that they plan on that to continue growing for them to spend more and more money on AI. Morgan Stanley projects that these investments by companies will contribute to 0.5% of GDP this year and next year. So if this pays off, which it seems like it will eventually, yeah, that's gonna sound good for companies, but who loses in this? Well, workers do, employees do. Workers get the short end of the stick. So far, since 2022, there have been about 100,000 employees that have lost their jobs and been laid off to AI advancements. And with that, the labor market has been where the eye of the crowd has been lying on for many reasons. The main being that it's a sign of how well or bad the economy is, and if rate cuts are a possibility. And we got a big one today, the big one. We got the employment report from the BLS. So what we've seen is that the BLS reported the U.S. job growth, and what it showed is that those numbers came in far lower than expected for July. The number was expected to come in at around 100,000, as high as 115,000. It just kind of depend on who you were looking at estimates from. And what that number showed that we actually got from the BLS in July was an addition of 73,000 jobs. So that's a lot less than the 100,000 that was expected. There were also massive revisions for prior months, revising them down. And this one was the big O question mark, because revisions for May and June were larger than normal. The change in total non-farm payroll employment for both for May was revised down by 125,000 jobs. So it went from plus 144,000 to only plus 19,000. Think about that. And then think about this next one. The change for June was revised down by 133,000. So it went from plus 147,000 jobs created to only 14,000 jobs created. That's crazy. And together that was the largest revision since 2013. How is that even possible that you miss by such a mark? And then back to just some of the more current numbers from this report for July. The unemployment rate also ticked up to 4.2%. Layoffs are still not bad, but there are layoffs being announced. Some of these aren't necessarily like as of today, but let's just go through the line. So Moderna would reduce its headcount by the end of the year to under 5,000, down from 5,800 at the beginning of this year. Procter & Gamble announced in June that it would cut 15% of its non-manufacturing workforce, or up to 7,000 jobs. July, Microsoft said it was cutting 9,000 jobs, or about 4% of its global workforce. Intel cutting 15% of its workforce. An even greater number of companies are simply slowing or freezing hiring, which has been the trend for quite some time now. And you can think to blame tariffs. Yeah, it's tariffs' fault. But even then, how can you just miss by such a mark, by so much on these job estimates? And some people like Trump, for example, are pointing towards possible manipulation. And what he ordered was his team to fire the Bureau of Labor Statistics Commissioner Erica I don't know how to say her name. Let's just call her Erica. Saying she'll be replaced immediately with somebody more competent and qualified. And it's worth noting that this is a survey, and that and it records estimates. So these are only estimates that they get in, and it's a survey. And that the past response rates were lower, but still, how do you miss by such a mark on these revisions? And with yesterday's hot PCE inflation read that we got, a weakened, and plus add in today's weaker or weakening labor market, it's sounding a lot like the ingredients that lead to stagflation, which a lot of people have been worried about heading into the end of the year. And we're 1 day out of July, so we're not even completely out of summer yet. School ain't even started yet. And we're already starting to see this massive downtrend. And with the revisions, it started a lot earlier than people were expecting. And oh man. So we've seen the treasury yields for both longer term and shorter term treasury yields drop, showing that there's this message from the bond market that the economy may need some type of stimulus from rate cuts back from the Fed. And yesterday we seen the odds of a September rate cut completely disappear in yesterday's video. I believe it was pretty much guaranteed that at September's meeting the Fed was going to stay the same. Well, if you look today, that completely reversed. So now we're sitting at almost 90% chance that the Fed is going to cut rates. And these are wild moves. And from what traders are betting versus what the Fed members are saying, it's not really lining up. Jerome Powell almost looks like he didn't know what he was talking about. Yes, on what was it, Wednesday's press conference? Was it Wednesday or Thursday? I don't remember, but it's just not lining up. And they got all these PhDs and high level models and forecasts and equations. And how did y'all not see this coming? So I'd imagine it's really tough being in the middle of the spotlight with the president repeatedly firing shots at you and bashing you and too late, pal, this and lower rates tomorrow, or I'm going to fire you and then I'm not going to fire you. That could be the reason why we got some of the news we got today, which let's get into it. So this one is pretty interesting. Nobody was really expecting this one. They thought Jerome Powell might have been the one to do this, but no, it wasn't. So we seen Adriana Kugler announce that she'd be resigning next week. And she was a Fed governor whose term was set to expire next year. This was going to be around the beginning of the year in January. But in a letter to Trump, she decided to wrap that up, resigning by August 8th without stating any reasons why. But I'm sure it's just with all of the moving pieces and uncertainty and the Fed being in this really weird spot. And it's almost like, forget the U.S. versus some other country. It's the White House versus the Federal Reserve Bank right now. That's the war everybody's watching. And it's a reality TV show at the same time. So that leaves Trump with a vacancy on the 7-member Fed Board of Governors, which Trump would be able to nominate. At the same time that 2 members have already dissented from the rest of the board, arguing for rate cuts. And we heard from 2 of those Fed members that dissented. The first being Michelle Bowman, and what she pretty much sees as success towards reaching the Fed's inflation target. They didn't get all the way there, but they got really dang close. She sees tariffs as a one-time price increase and supports cutting rates to prevent further deterioration in the labor market, which we are seeing based on today's data. So let's read into her statement that was released on the Fed website today. Inflation has moved considerably close to our target after excluding temporary effects from tariffs, and the labor market remains near full employment. With economic growth slowing this year and signs of a less dynamic labor market, I saw it as appropriate to begin gradually moving our moderately restrictive policy stance towards a neutral setting. And we'll see more on the neutral rate here in a bit when we talk about the other member who dissented. But some of the increased concerns about our employment mandate, with inflation on a sustained trajectory toward 2%, softness in aggregate demand, and signs of fragility in the labor market, I think that we should start putting more weight on the risks to our employment mandate, because they want to balance a stable employment market and inflation. And right now she's saying inflation's probably not our concern because these tariffs are just a one-off. It's the employment, the labor market that we should be watching. And if the labor market gets bad and people can't spend money and then they start saving, that can have dire effects on the economy. And it's hard to reverse that. If demand conditions do not improve, firms may have little opinion other than to begin to lay off workers, recognizing that it may not be as difficult to rehire given the shift in the labor market conditions. Tariff-related policy increases likely representing a one-time effect. It is appropriate to look through the temporarily elevated inflation readings. So she's probably mentioning yesterday's PCE report. So yeah, Jerome Powell's press conference should have been on Wednesday. PCE came out yesterday and it was a bit hot. So she's saying, hey, let's look past the hotter than expected PCE, which was barely hotter than people were expecting it to come in. So she wants to move our policy rate at a gradual pace towards its neutral level, which will help maintain the labor market near full employment. And she sees the risk that a delay in taking action could result in a deterioration in the labor market and a further slowing in economic growth. So that's what we heard from Michelle Bowman, who was one of the Fed governors who supported rate cuts. And then Christopher Waller was another one. And some people are like, they just both wanted to apply for the Fed chair position that's going to be coming up if Jerome Powell gets removed or replaced or retires, whatever he does, they're just applying for that job with Trump. But overall, Christopher Waller pretty much had a similar stance to what Michelle Bowman had to say. So let's look at his statement. He pretty much recapped the reasons for why he supported a rate cut. So the first was that tariffs are a one-off increase in price level. The second is that a host of data argues that the monetary pace should be close to neutral, not restrictive. GDP growth was 1.2% in the first half of the year and is expected to remain soft for the rest of 2025. The unemployment rate is 4.1%. Total inflation is close to our target at just slightly above 2%. The data implies that the policy rate should be around neutral, which the median FOMC participant estimates is 3%, and not where we are, which is 1.25 to 1.5 percentage points above 3%. So they're saying, pretty much he's saying the neutral rate isn't where we're at. We're pretty much 1.5 points above to where the rate should be based on these data that he just mentioned in this paragraph I just read. My final reason to cut now is that while the labor market looks fine on the surface, or does it based on today's data, once we account for expected data revisions, private sector payroll growth is near stall speed, and other data suggests that the downside risks to the labor market have increased. With underlying inflation near target and the upside risk to inflation limited, we should not wait until the labor market deteriorates before we cut the policy rate. So he's pretty much saying, because usually the Fed's late at cutting rates and late to reacting because they react to economic forces. He's saying, rather than what we did in the past, let's just go ahead and jump ahead of it. Let's react now. And then worst case scenario, we don't have to cut at the next meeting or the next meeting after that, but at least we can go from there rather than reacting too late. But in other news, let's talk about tariffs now. So tariffs are still weighing on not even just countries and consumers. Think about your businesses like restaurants who are asking Trump for mercy from tariffs due to higher costs and the impacts that has on demand. So in a statement today, the National Restaurant Association trade group said that the decision to increase duties on dozens of nations could drive up costs for its members. Restaurants would likely pass those higher costs to consumers, given other rising expenses. Fewer people are dining out jeopardizes an industry that supports millions of jobs in local economies, which this doesn't really align with the points of view that those two dissenting Fed governors had, Christopher Waller and Michelle Bowman, because they're saying that these costs could potentially keep on rising, and these rising expenses will offset demand, which will offset millions of jobs. So restaurants are grappling with declining customer traffic this year as consumers pull back on their spending. I'm a cheapskate, so I usually always eat at home. I just make burritos every single day, and that's an easy one and done. Rice, beans, pick your meat, vegetables. So I like the bell peppers, tomatoes, get some guac every now and then, jalapenos, that kind of stuff. Sometimes even some sweet potatoes in it. Fry them things up. Put some Greek yogurt in it. There's my recipe. The association said that the food and beverage products aren't major contributors to trade imbalances and urged the administration to exempt the goods from duties during negotiations with Canada, Mexico, and other countries. The group is particularly concerned about tariffs on goods from Brazil and the European Union, which could hike costs on coffee, beef, European food, wine, and spirits, which is technically real similar to wine. Beef prices have already hit record highs. But it doesn't end there, because lumber prices hit a 3-year high. And what does lumber really impact? The cost of new homes that are being built today. So I guess you could always buy an older home, but if new homes are going up, the competitors, or usually new homes compete with used homes, so when new homes go up in value, used homes aren't, they're gonna kind of like peep that and be like, like, let's raise up our costs a little bit since the competition's raised up. Like, they might not raise up costs as high, but you know, they want some of that juicy price increase. So what we see is that lumber futures hit their highest price in 3 years. Though wood demand has been slow, is what this word stands for, traders are pricing in dramatically higher duties on lumber imports from Canada. Lumber futures for September delivery hit $695 per 1,000 board feet. That was as of today, which is up 39%. 39% from a year ago, the highest price since summer 2022. And I think that's all we were going to cover as far as this one. But lumber is a big one for Canada, and Canada's tariff rates were increased. So Canada seen their rates go from 25% to 35%. And Canada, the question was in the air as to whether or not they retaliate. And I was reading this article earlier saying that Canada is unlikely to try to retaliate, which is the word on the street, Wall Street Journal. And it's probably because Trump has voiced that retaliatory measures can lead to higher tariff rates, even higher than where they're at. So while Canadian officials expressed disappointment with Trump's decision to increase their tariff rates, and I'd imagine it's because they're not coming and shaking a hand and having a deal made. This is just motivation to get it going. They expressed disappointment, but they didn't mention retaliation as an outcome. They didn't mention it. So, you know, there could be this crazy headline that just comes up out of nowhere and they play the Trump card on Trump. But let's look at a list of the rates issued on all of these countries as of Thursday. I'm not going to go through all of these. You can look at the screen, pause it, zoom in, look at them. But let's go from lowest to highest is how they're listed. And we see UK 10%, European Union, Iceland, Costa Rica, Israel, Japan, South Korea. Those are some of the countries that got this 15% rate. It's a whole bunch of them on that one. Nicaragua, 18%, Cambodia, Indonesia, Pakistan, Malaysia, Philippines, Thailand, they got 19%. Sri Lanka, Bangladesh, Taiwan, Vietnam, 20%. India, they got 25%. Algeria, Libya, South Africa, 30%. Iraq, Serbia, 35%. Switzerland, 39%. I don't know how to necessarily say any of these two countries, but Myanmar, 40%. Syria, 41%. And Brazil was assigned a 10% reciprocal tariff for its goods, but is facing a 50% tariff overall because of higher penalties. Tariffs will stay at 10% for goods from economies that weren't named. So think like Australia, Argentina, Chile, Colombia, Qatar, Saudi Arabia, and Kuwait. So that's a bit on tariffs, and they're all used to. A lot of people are wondering where all this money is being used. What are we doing with all of this tariff revenue that we're getting? And Trump said that they're going to use it to pay down the nation's debt. They're going to fund the government as revenue. And because the government got bills to pay, they got to keep the lights on. There's a ton of employees and whatnot for the government, even though it like moves pretty slow, and that's pretty questionable, which is where Doge came out. But I digress. And then he even said potentially a small rebate back to Americans. And we're waiting for more news on this. But he said that some of that revenue money could come back as a check to Americans. So we'll keep on watching this one. But in other news, we got factory orders data. And what we've seen is that the factory sector continued to contract for the fifth straight month in July. The ISM Institute showed. So this index measures the U.S. manufacturing activity, which fell from 49 to 48 in July, according to the Institute for Supply Management on Friday. Economists surveyed by the Wall Street Journal had forecast that this index to inch higher to 49.5%. So instead of increasing like the Wall Street Journal expected would happen, we instead fell. And we're still below 50, which indicates contraction. And this is for the fifth straight month in this contraction territory. And let's continue, because we also seen that consumers are feeling pretty well. And my computer just crashed a little bit. So American households ended July feeling slightly more upbeat than in previous months, according to the University of Michigan's index of consumer sentiment. And what we've seen is that it rose, a good little amount from 60.7 in June to 61.7 in July. Inflation expectations for the year ahead declined for the second straight month, falling to 4.5% from 5% in June. And this was the lowest since February, but higher than what consumers expected in December 2024 after the election. So people are feeling better about how the economy's going. I'm wondering how this would be reflected in the data if they were all asked again, like right now, like, how are you feeling about the economy now that tariffs have hit? And now that we're heading into August and September, where the stock market is historically known to perform a little bit worse than on average for other months. But wait, there's more, and this one's more so in the form of a geopolitical warning. And, in the past, geopolitical warnings are known as buy the dip opportunities. But, with everything we've had this year, just literally everything piled on top of each other like a cake, I just don't know. It's just uncertain. So looking at this, oil prices briefly pair losses as Trump says he moved 2 nuclear submarines. A warning from President Donald Trump aimed at Russia former Presidents Dmitry Medvedev sent oil prices off their lows after he said he moved 2 nuclear submarines to be positioned in the appropriate regions, just in case these foolish and inflammatory statements are more than just that. And you can check out what the note was. They said it was on Telegram, so you could Google around. I'm not going to read this whole thing. I'm running out of voice on y'all. But I'd say the main thing here is that heading into August, we're just now getting out of the main month for stock gains. If you watch stocks or even the economy, that part of the market cycle is now going into the past. And Fed officials, economists, CEOs of companies, everybody was forecasting that there's going to be some slowdown sometime this year, and that they forecast that it was going to be the end of the year. So what do we got? From a jobs market that's starting to crack, to rising costs that threaten businesses, big and small, the signals are piling up. And while tariffs, oil prices, and the Fed policy dominate the headlines, the bigger story is how all of these forces are colliding at once. And the question is whether the market can weather the storm, or if we're just at the beginning of something much bigger. So stay tuned, everybody. Stay informed, stay focused, and I plan on seeing you here again. See you next time.